Welcome back to Fast Market, everyone. Kevin Hinks and Kevin Green here. Now for our cash tag segment, I want to bring in the co-founder of LikeFolio.com, Mr. Andy Swan, to the show. He's going to talk about our feature stock of the day, and that is Dick's Sporting Goods, coming out with the earnings tomorrow morning before the open. Andy, an acquisition. I'm going to give you my take on their acquisition, and you can tell me how wrong I am. I think the street got this dead wrong when they thought this was a negative purchase for Dick's Sporting Goods. $2.5 billion is not a lot of money, and it puts them in smaller shops in malls. Andy, tell me why I'm wrong. Why is the street, in my opinion, getting this so wrong?
Yeah, I don't think you're wrong at all. I completely agree. I think the street got this wrong. I think basically the street just doesn't like the idea of an acquisition in this environment because everybody in the sector is down. We look at web visits across all of these channels, whether it's Dick's, Foot Locker, Academy Sports. Everybody's down. Nike's down. It's just not a great time to be in this business. But I think Dick's is looking at a much longer term perspective than Wall Street is. And just like you're saying, what they're saying is, look, we are really good at, once we get a customer, keeping them coming back. If you look at their engagement on the app that they have, that's up 41%, which is year over year, which is an enormous number. They're doing a much better job, a very good job of keeping their customers engaged, reaching out to their customers and capturing that customer information pretty much with every visit. And so when you think about it from that perspective, then getting yourself expanding the top of that funnel into malls and smaller footprint stores where a lot, let's face it, a lot of people that are more like the street sneakers types and so on, they're going into Foot Locker, they're not going into Dick's. But if you can turn those Foot Locker visitors into Dick's customers and entice them out to your other stores, then you've got a much more expanded customer base and something that you've proven that you're very good at, and that is keeping your customers, making them happy, and continuing to bring them back into the store. And so I like what Dick's is doing here. I think Wall Street's got it wrong. I think they're kind of throwing the baby out with the bathwater because, you're kind of combining two companies that are struggling right now. But like you said, I don't think it's an unreasonable price to pay for Foot Locker. And I think long-term, Dick's shareholders are going to be very happy with this deal.
Andy, what do you see as potential risk when it comes to competition within this space? Obviously, we're starting to see more consolidation. Do you think that there's a particular company like Academy that's kind of eating into Dick's market share right now, or is that not the case?
Yeah, we really don't. I don't see much coming out of Academy. Honestly, I think the advantage that Dick's is working with is only growing, and they're leveraging up against Academy. If I were Academy, I'd be much more scared of what Dick's is doing than the other way around. I think that the biggest risk to all these companies, Nike has seen it, is just the upstarts. The small companies, direct to consumer companies, that entire movement. You look at the success that On Running has had. You look at the success that some other smaller competitors have had at chipping away at Nike. The same exact thing impacts Dick's Sporting Goods, because now all of a sudden, instead of going in for new shoes every 4 or 6 months, if you're a pretty athletic person, they're being delivered to you, and you're not needing to go into the store at all and end up picking up some extra items. So I think that's the biggest risk for Dick's. It's not competitive in their space, really. It's more the consumer macro behavior, how that's changing. I think that's a real concern for Dick's. But I think that the Foot Locker acquisition helps them kind of stave that off by being in more locations and getting more customer eyeballs and more importantly, more customer information into their very, very robust database.
Yeah, Andy, I think, number one, I think this is a complex issue. But I'll admit where I got it wrong is I thought direct-to-consumer would completely change this business and it would never come back. I really thought that. However, it hasn't. And so I think Dick's is reading the room here and saying, if brick and mortar is still alive, why wouldn't we buy brick and mortar at a heavily discounted price? make it into a smaller little boutique Dick's all over the country and take advantage. If the customer says they want to go in a store, then listen to them and get more stores, because I thought direct to consumer, though it's still popular, Nike, it ended up, they're back on Amazon now, and they're back on other places selling. So it just, I think this is Dick's evolving with the U.S. consumer that frankly is an incredibly fast moving target, the U.S. consumer. And I think the number one point, $2.5 billion is not a lot of money to a company like Dick's. So even if they don't get synergies, even if they don't fix this brand and make it better, they didn't spend that much money on this entire franchise.
Yeah, no, I completely agree. In fact, I think, we can draw a parallel, because I'm with you. I thought direct to consumer would impact this industry a lot more than it had. But, you can really draw the parallel with Walmart, I think. Dick's has got huge stores, huge brick and mortar footprint, a lot of market share, and a very well-known name, a lot like Walmart. And everybody got very frustrated with Walmart, how slow they were to go to online and direct to consumer. But what they did instead was they just got it right, and they got the mix right. And now their shareholders are benefiting. I think that's the same thing we can say from Dick's Sporting Goods, because when I saw their app usage data up 41% year over year, that tells me that they get it. They understand they're going to meet the customer where they are, whether that's online, on their phone, in a mall, via a Foot Locker store, or out in the burbs at one of these one of these big stores that they already have. So I think this is a great move by Dick's. I think that they're executing on a really solid long-term plan, and I think shareholders will be rewarded. And I'm really hopeful that starts tomorrow with this earnings call.
Yeah, me too. I think this is a great conversation to have, and great companies that have sold off. I think this is what we're talking about here. But Andy Swan, thanks for coming on as always, bringing the LikeFolio data to Fast Market. We always appreciate it. Have a good day, Andy. All right, Kev Green, you have a